when you look at the credit markets in China, bond markets in China, are they attractive to you?
Yeah, they are. And China continues to struggle with the zero COVID policy and the constant shutdowns. So it's going to take a lot off of GDP. And because of that, we think that GDP will come in somewhere around 3%. You look at the 10-year China government bond, it's yielding about 2.8%. That looks to be pretty good value to us. I think for us, one of the bigger discussions we're having is, what does zero COVID policy mean for recession and inflation? And unfortunately, it means stagflation. It means that you're taking out a large area of consumption, but you're still going to have the supply bottlenecks. That's not necessarily good for the rest of the economy.
Erin, what about you? Is China investable right now?
Yeah, this is somewhere where Bob and I actually agree. I think that, from a Chinese bond perspective, I think Chinese bonds do offer value, particularly in a global construct. That said, I think the big question mark for China right now is what they're going to do with respect to their currency. I believe that their currency is likely going to continue to weaken in a zero COVID policy where growth really is handicapped. And as a result of that, I think that likely means that it's going to really harbor poorly for the rest of the world. Remember, historically, it's been difficult for emerging market assets to do well in environments where China growth is very weak. And particularly if China continues to weaken its currency or allow for its currency to gradually weaken, it also means that you won't likely see emerging market strength outside of China. What that ultimately means is that it's pretty poor for global growth. I think people have been expecting, investors have been expecting that you would likely see some type of recovery in China, particularly this year and in the back half of this year. I don't think that we're going to get it, which makes, in my mind, Chinese risk assets pretty uninvestable right now.
This is where I'm going to disagree with Erin again. We're back on track, Erin, okay? We're looking at the rest of the emerging markets, emerging market debt, and we think that could be the surprise of the second half of the year.
Well, upside surprise?
For the bond market, wow. Absolutely. And if you look at the developed market central banks, really, when you look at the ECB just starting to raise rates, the Fed early on, and the Bank of Japan not starting, in the emerging markets since the start of 2021, 30 central banks have raised rates 170 times for a total of 15,000 basis points. So those markets have anticipated inflation, they've priced it in, there are high real yields there. People are afraid to go in because of inflation, because of the strong dollar. We think there's an opportunity there. You put together a basket of Brazil, South Africa, and Mexico, you've got a 7.25% yield. All you need is for the dollar to remain stable and not keep going up.
All you need, Erin. All you need is the dollar to remain stable. Bob took us actually to ECB. What about Europe?
Yeah, well, I just want to go back to that point just really briefly. I mean, Bob, earlier you were saying you can get an 8% yield out of high yield. So why would you get a 7% yield out of emerging market assets if it's a lower quality asset with more FX risk on it? I think that in order to be bullish emerging market assets, you need twofold. You need, one, to see a stabilization in global growth. And probably even much more importantly, you need to see inflation stabilize in emerging markets. Unless and until you see inflation stabilizing, you're going to continue to see those central banks chasing and trying to get in control of inflation. And that just means that, likely you're going to see higher rates in emerging markets. So I think it's too early right now to call for a buy in emerging market assets in emerging market bonds. With respect to Europe, I think that Europe is really challenged right now. And that's, largely as a result of the fact that they have much higher reliance on energy and gas from Russia than the rest of the world, and particularly versus the US. And so I think that you're going to see a real impairment to European corporates in the second half of the year because of higher energy costs. And I also think that you're going to see a forced curtailment of industrial energy usage, which means that corporate profitability in Europe is going to be quite weak. I do think that based on some of the PMI data that we got over the last 48 hours out of Europe, that we're likely in a recession in the third quarter in Europe at the start of a recession. And you'll likely see that recession conditions ensue over the next few quarters. So I think that Europe is a real bleak spot in terms of the global growth trajectory.
So,
Sir, rebuttal?
yeah, I'm going back to emerging markets.
I knew you were.
Because I think there are three sovereigns who aren't going to be really happy that they just got compared to below investment grade U.S. corporates. So let's put that to the side. Europe, yeah, I agree with Erin. They've got a real problem. It looks like inflation's going to remain structurally high. The ECB is going to do what they can to slow down consumption. Ultimately, we like sovereign debt there, but we like Germany. We're not necessarily sold on Italy yet. So we're sticking in the sovereign side. We think there's some normalization in policy to come from the ECB, but they're not going to get anywhere near as high in rates as the Federal Reserve.
So, Erin, to put you on the spot, what's the worst problem for Europe right now? The collapse of the government in Italy, or the problem that ECB faces, and particularly Russian natural gas?
I think energy is by far the number one problem that Europe is facing right now. For Italy specifically, certainly the collapse of the government is a challenge, but I think that the much larger looming risk out there is the curtailment in what's going to be in supply into Europe for natural gas, and what that ultimately is going to mean for demand destruction that's necessary to come from it.
What does that say to you as a bond investor in Europe?
Well, it says a couple of things. It tells us to be careful on corporate Europe because the input cost pressures aren't going to go away anytime soon. It tells us that the ECB can only raise rates so high, maybe 1.5%, 1.75%. That's about it. And it means that you're going to want that flight to quality. So as I said, German government debt is the place for us to be there.
So last question here, Erin. You heard Bob say, provided we have a stable dollar. What do you expect the dollar to do from here on out? Will it continue to strengthen against other currencies?
Unfortunately, I think we're still in a period of dollar exceptionalism, which means that because of the somewhat relative better growth trajectory of the US versus Europe, because of the less reliance on Russia as a source of natural gas and energy, and because of the defensive properties of the dollar, I do think that the dollar is likely to remain quite robust over the next couple of quarters. And so I think that the dollar is likely going to continue to strengthen.
Do you agree with Erin on that one, Bob?
No, I think the dollar has peaked. And even Erin was talking about the downside to the U.S. economy. The dollar's gone as far as it can. It's really stretched versus all currencies.